Welcome to part 2 of this series. In the last video, we saw just how overwhelming David's tax return really is. Dozens of forms, multiple income streams, and enough paperwork to bury a kitchen table. Now, David finally begins filling out the actual IRS forms. And the very first one he has to complete is Schedule C, the form that reports his Uber and DoorDash income. This single form determines his business profit, triggers self-employment tax, and sends numbers directly into both Schedule 1 and Schedule SE. So let's break it down step by step and walk through exactly how David fills out his Schedule C. Before touching Schedule C, David has to gather all the documents that support his gig income and his expenses. Here's what he needs. After gathering his documents, David builds his own vehicle expense spreadsheet. This is where he calculates his business miles, applies the IRS standard mileage rate, and figures out his deduction for the year. For most gig workers, vehicle expenses are the largest deduction they'll take all year, and the IRS gives them two options: the standard mileage rate or the actual expense method, whichever results in the bigger deduction. First, he puts on the spreadsheet that he has the 2023 Tesla Model Y. Next is total miles driven during the year, 32,000. This is the total number of miles David put on his Tesla in 2025. That includes personal, commuting, and business combined. Business miles driven during the year. These are the miles driven specifically for Uber and DoorDash. The IRS requires you to keep a mileage log, and David tracked all 27,000 miles. So the business use is 27,000 miles divided by 32,000 miles gives him 84% business use. So the standard mileage deduction is the business miles driven during the year, 27,000 times the standard mileage rate of 70 cents per mile gives him 18,900. That is the amount that goes on Schedule C. Below that we see actual expenses, all zero in David's case. David didn't track gas, repairs, insurance, or maintenance because he chose the standard mileage method. When you use standard mileage, you cannot claim these again. They're already built into the mileage rate. Here's an important clarification about mileage tracking. DoorDash shows mileage on their annual summary, but the IRS does not use that number. It's just a helpful estimate. For taxes, the IRS requires your own mileage log, not DoorDash's estimate, which is why David tracks his miles independently throughout the year. Another clarification is that the standard mileage is often better for David and most gig drivers because the standard mileage already includes depreciation. If you use standard mileage, you do not calculate depreciation separately. The IRS already includes a built-in depreciation amount inside the mileage rate. So since he used the standard mileage, he cannot also claim depreciation, so he does not need Form 4562, depreciation and amortization. But even if David tried the actual expense method, depreciation plus every minor expense he has, he would still fall thousands of dollars below the standard mileage deduction. His Tesla has almost no operating costs, and the IRS depreciation caps limit how much he can deduct. That's why standard mileage wins by a landslide for most gig drivers, especially EV drivers. So the simple rule of thumb, if your actual expenses, including depreciation, is greater than your standard mileage, use the actual. If not, use the standard. Most gig drivers prefer standard mileage because it's simpler, usually gives them a higher deduction. No Form 4562, no tracking individual expenses. If you use the actual expense method, you must depreciate your vehicle. And so at the very bottom of this spreadsheet, it shows the amount to enter on Schedule C. Car and truck is $18,900. Next, David creates another spreadsheet for his home office deduction. Now this is where things get tricky because the IRS has very specific rules about what you can and can't deduct. So how does David know his home office qualifies for the home office deduction? Well, the IRS requires that the space be used exclusively for business. Gig workers don't need an office to do their job, but if they use the room exclusively for managing their business, the IRS still allows a home office deduction. In David's case, he uses his home office to track mileage, organize receipts, manage taxes, review earnings, plan his schedule, charge his equipment, update spreadsheets, and store his business supplies. So this is a yes or no test. If the room is used for personal activities, the deduction is not allowed at all. So David does qualify for the home office business deduction. So on the spreadsheet, it shows that his total area of home is 1,200 square feet and 120 square feet used for business. So 120 divided by 1,200 equals 10% business use. That 10% is what the IRS lets him apply to his indirect expenses, the costs that benefit the entire home. So what is indirect expenses versus direct expenses? Indirect expenses benefit the whole home. Things like utilities, mortgage interest, homeowners insurance, and trash services. Direct expenses are repairs or costs that apply only to the office itself. For example, patching the drywall inside the office, replacing the carpet only in that room, painting the office walls. So David has zero direct expenses because he didn't spend any money fixing or improving the office room itself. Direct expenses are rare. They only happen when you repair or renovate the office specifically. Everything he paid for this year benefited the entire home, so they're indirect expenses. And because David owns his home, the biggest items on this worksheet are mortgage interest and real estate taxes. So he has $18,000 of mortgage interest and $10,000 of real estate taxes. Divide each of those by 10% and you have $1,800 and $1,000. Alright, so he also has insurance, homeowners insurance. He paid utilities, miscellaneous items, DSL. He divides each of those by 10%. He has his total 636, adding with the real estate expenses. So that gives him a total home office deduction of $3,436. We also see here that he has $600 in miscellaneous. Miscellaneous covers small household expenses that benefit the entire home, like cleaning supplies or minor general repairs. Since they support the whole house, they are treated as indirect expenses, and only 10% is deductible in this case. And here's an example of how that works. Alright, next David builds another worksheet, the last worksheet for the Schedule C. It's called the Schedule C Reconciliation. These spreadsheets aren't necessary, it just helps to gather everything into one document before transferring over to the Schedule C. Alright, so here we see David's total gig income is $28,000 from Uber and $10,000 from DoorDash, equaling $38,000. Uber's 1099K shows what customers paid before Uber takes its cut. So we'll deduct Uber's $3,200 marketplace fees later as commissions and fees on Schedule C. DoorDash works differently. DoorDash drivers can receive a 1099 NEC, a 1099K, or even both, depending on how their payments were processed. In David's case, he only received a 1099 NEC. That $10,000 already reflects what DoorDash paid him after their fees, so the entire amount is treated as his gross business income. Almost every gig platform reports income differently, so you always have to check how the payments were processed. A 1099K reports gross customer payments, so you must deduct the platform's fees separately. A 1099 NEC usually reports your net contractor pay after the platform's fees have already been removed. In David's case, both numbers count as gross receipts on Schedule C. Alright, next we see car and truck of $18,900. That came from his other worksheet, the vehicle expenses worksheet. That total is just the 27,000 business miles times 70 cents per mile. Commission of $3,200. Remember how Uber's 1099K reports customer payments before Uber takes its cut? Well, that $3,200 marketplace fee is deducted here under commissions. This is where we record Uber's platform fee as an expense on Schedule C. DoorDash doesn't have a commission listed here because their 1099 NEC already shows the amount they paid David after subtracting their fees. Their cut is built into the $10,000 total, so there's nothing additional to deduct. Alright, next we see supplies of $350. This includes small business purchases like phone mounts, chargers, cleaning wipes, and water bottles for riders. Alright, next we have business use of home of $3,436. That came from his home office business deduction spreadsheet. Next we see telephone, $672. David uses his phone heavily for gig work, GPS, Uber and DoorDash apps, customer messages, and navigation. But after reviewing his usage, only 80% of his phone bill is used for business. His total annual phone cost is $70 times 12 months is $840. Applying the business use percentage, $840 times 80% equals $672. That's the amount he's allowed to deduct on Schedule C. David saves his phone bill each month. To find his business percentage, he uses one simple calculation: business calls plus business texts divided by total calls plus total texts. That gives him his business use percentage for the phone. This is exactly what the IRS wants to see if he's ever audited. Okay, next we have $522 for other. This is a catch-all category for miscellaneous items that don't fit neatly anywhere else. Car washes, parking fees, vacuum cleaning, or occasional small supplies. Adding everything up, mileage, commissions, supplies, home office, phone, and other expenses, $27,078. So his business income of $38,000 minus his total expenses of $27,078 equals $10,922 in net income. Now David is finally ready to transfer everything into Schedule C line by line. Alright, so here's Schedule C and what David filled out. Let's go through it step by step. David enters his legal name at the top along with his social security number. Even though some people have a business name or an LLC, Schedule C is filed under the owner's name unless the business is taxed as a corporation. For line A, the IRS wants a clear, simple description of the business activity. So David writes rideshare and food delivery services. That covers both Uber and DoorDash. For line B, David needs to enter the correct business activity code. He finds this by opening the Schedule C instructions, where the IRS includes a long list of business codes in the back. David scrolls through the list until he reaches the transportation category. That's where rideshare work is classified. He looks for the description that matches his activity, and the closest one is taxi and limousine services, which is code 485300. So that's the code he'll enter in box B. If David uses the wrong business code on line B, nothing really happens. If the code is close, the IRS doesn't really care too much. They won't fix it, and your return will still go through. It only becomes an issue if the code is completely unrelated to the business. It makes your expenses look unusual for that industry. Line C, business name. David doesn't operate under an LLC or separate business name, so he leaves this blank. If he had a business name like David Rides LLC, it would go here. Line D, employer identification number. David hasn't applied for an EIN because he files taxes under his social security number, so he leaves this section blank too. Line E, business address. David enters his home address. Even though he drives around the city, his business headquarters, the place where he manages everything, is his home. Line F, accounting method. Now David chooses his accounting method. Like most small businesses, he uses the cash method, which means he reports income when he receives it and expenses it when he pays them. So he checks a box for cash. Line G asks whether David materially participated in the business, and that simply means did he actually do the work himself. The IRS uses this question to separate two types of business owners: active owners and passive owners. Active owners, people who actually run the business, like David driving for Uber and DoorDash. Passive owners, people who invest money in a business but don't work in it day to day. But why does this matter? Because passive activities have special rules. Passive losses can't always be deducted unless you actively take part in the business. In David's case, this is easy. He's the one doing the driving, choosing his hours, tracking mileage, managing trips, and earning the money. So David is clearly an active participant, and he checks yes for material participation. Line H. Line H asks whether David started his business in 2024. What matters here is the start of the business itself, not each individual platform. Let's say David started driving for Uber back in 2023, then his business began in 2023, even if he added DoorDash later in 2024. Adding a new app doesn't count as starting a new business. It's just expanding the same activity. So because David already started his gig in 2023, he does not check this box, even though he added DoorDash in 2024. Line I, did you make payments that require you to file 1099s? This asks David if he paid anyone else, like subcontractors, more than $600 during the year. He didn't hire anyone, so he checks no. Line J, if yes, did you file 1099s? Since David didn't need to issue any 1099s, he checks no here as well. Part 1, income. Line 1, gross receipts or sales. David enters $38,000 here. This is the total gross income from Uber and DoorDash. Line 2, returns and allowances, he leaves blank. David isn't selling any products, so he has no returns or refunds. Line 3 is just subtracting line 2 from line 1. Since there were no returns, line 3 is still $38,000. Line 4, cost of goods sold, blank, because gig workers don't have cost of goods sold unless they sell physical items. Not in this case for David. Line 5, gross profit, still $38,000. That's line 3 minus line 4. Line 6, other income, blank. David didn't receive any fuel credits, grants, or other special income. Line 7, gross income. His gross income remains $38,000. Next we have part 2, expenses. Alright, first let's explain which home office method David should use. When it comes to the home office deduction, you have two choices, just like choosing between standard mileage and actual vehicle expenses. With the actual method for the home office, you deduct a percentage of your real home costs: mortgage interest, property taxes, utilities, insurance, repairs, HOA fees, and even depreciation on your home. For David, the actual method would actually give him a much larger deduction, over $3,400, because his mortgage interest and real estate taxes are high. But the trade-off is complexity. It requires Form 8829, detailed record keeping, allocation of indirect and direct expenses, and depreciation that triggers recapture tax when he eventually sells his home. This is what we saw on his business home office deduction worksheet. The simplified home office method requires you to use the actual measured size of your workspace. It must be the real square footage, used exclusively and regularly for your business. David's office area is 120 square feet, and the simplified method gives him $5 per square foot. So his home office deduction is 120 times 5 is $600. The simplified method is easy. No Form 8829, no depreciation, and far less audit risk. That's the reason why David chose to go with the simplified method, because it keeps his return clean and avoids extra paperwork. His final home office deduction is therefore $600, and that amount goes directly on line 30 of Schedule C. Alright, so let's go down to the list of what he has here. So the only things he has here is car and truck expenses on line 9, and commissions and fees on line 10. He also has $350 on line 22. Now these numbers are coming from the Schedule C reconciliation worksheet that David created earlier. Next we see line 27 of 1,192. That comes from line 48, and that's page 2 of Schedule C, part 5. So if we look at the bottom here, page 2, Schedule C, part 5, other expenses, we see $672 for phone. That's 80% use of his phone, and $520 for miscellaneous expenses. And line 48 shows 1,192, which goes back to line 27A. Alright, line 28 is just total expenses before home office. David adds everything from line 8 through line 27B. His total is $23,642. Line 29 is just line 7 minus line 28. Line 30 is the home office deduction. So again, this is just the 120 square foot times $5 gives him $600. And then in line 31 is just subtracting line 30 from line 29. Alright, and then line 32, what does this mean? Line 32 is only for people who have a loss, not a profit. It asks whether all investment is at risk. This is used if the business has a loss and the owner's money is actually at risk of being lost. 32B, this is mainly used when using non-recourse loans, has investors guaranteeing losses, participates in special tax shelters. Extremely rare, does not apply to gig workers. So line 32 is only for people who had a loss. Since David made a profit, he leaves both boxes blank. Most gig workers never need to touch this line unless they're claiming losses and the at-risk rules apply. The at-risk rules limit how much loss you can deduct on your taxes. You're only allowed to deduct losses up to the amount of money you personally have at risk of losing in the business. So the only time the at-risk rules matter is when you have a loss and you're using borrowed money that you're not personally responsible for, or you're part of a special tax shelter. So since David made a profit, the at-risk rules don't apply, and line 32 stays blank. Alright, moving on to part 3, cost of goods sold. Since David doesn't sell any products or keep inventory, part 3 doesn't apply to him at all. He skips this entire page and leaves every line blank. Alright, part 4, information on your vehicle. He will refer back to his vehicle expense worksheet for this. He began driving for Uber and DoorDash on June 6, 2023, so that's the date he enters. Then he enters 27,000 for business miles. That's all the miles he drove while working for Uber and DoorDash. He enters 0 commuting miles. Why 0? Well, rideshare drivers start work the moment they open the app. There's no drive to a workplace, so the IRS says they have no commuting miles at all. Alright, line 45, David checks yes, because he also uses this car when he's not working. Line 46, he checks no, this is his only car. Line 47A, he checks yes, because he has trip logs, mileage summaries, and Uber, DoorDash trip history. Line 47B, he also checks yes here, because his mileage records are written and stored. Alright, now you see exactly how David's Schedule C works. His gig income, his mileage, his expenses, and how all of it comes together to calculate his business profit. And that profit is where the real tax begins. In the next video, we'll be tackling Schedule SE, the form that calculates his self-employment tax, explains the 92.35% rule, and show why gig workers owe so much more than regular employees. See you in part 3.